Hey guys, how you doing? So Dan from Trading with Dan here. So just a quick video today. I just wanted to have a quick chat about banning short selling. So a number of countries have actually banned it at the moment, or banned certain stocks, certain like stocks in certain sectors across Europe, and also some Asian stock markets as well. So I did just want to point out some of the reasons why banning short selling is bad, and also why it might not happen in, like, say, US stock markets or maybe even UK stock markets, because of the reasons why it is actually bad for the markets. Because you might think, okay, if people can't sell shares, can't short sell, then that means that markets can't go down, so that's great. But what it does actually mean is that it means there's a lot less liquidity in the market, because short sellers do provide a lot of liquidity in the market. So if you think about the actual word hedge fund, how they actually typically used to operate would be, I say used to because obviously they just take massive bets now, and then if they lose they get bailed out, so it's like a heads I win tails you lose sort of scenario. But historically, and obviously lots of hedge funds still will actually hedge their positions. So they'll be long short in like equities, so they may think a certain sector is going to go up, but they hedge out market risk by selling another sector that they think may go down, or they think a particular company within a sector might go up, so they'll buy that one, but they'll hedge it against another company in that same sector that they don't think is as good. So they're sort of hedging out overall market risk of the market going up and down, and then they're both simultaneously long and short, obviously with less actual overall risk. So they are in effect hedged, and obviously because they are hedged in this fashion, what it means is that their position has a lower risk. So that then means they can actually have bigger position sizes, because they're not just taking an outright long position in the stock fully exposed to market risk. Because obviously we know even in a market crash, all stocks will basically go down, even though some of those stocks are better than other stocks, but they all go down. So if you're long them and long only, then what that means is you're definitely going to lose money regardless. But if you were long the things you thought were good, and then short against it something you thought was bad, whether it be in the same sector, a different sector, or what it does mean is that you've got you can potentially make money even if the market goes down, because when the market goes down you expect the company that you're long, because your analysis tells you it's better, to go down less than the company that you hedged it against that isn't as good, that will then go down more. And obviously the opposite is true as well. If the market's going up, you'd expect the company that you're long, because you think it's a good company, will go up more than the one that you're short will go down. Go up. So obviously if the one you're short goes up less than the one that you're long goes up, then you'll make money overall. And similarly also, if you don't necessarily, you're taking a position based on you think a particular company is bad, so you want to go short that company, but you know that the market is generally going up, you can hedge that by going long a company in, say, the same sector that you think is better than that company. So then if the market goes up, yes, okay, the company you're short goes up as well, but because it isn't as good, and if you're correct it isn't as good, and the market doesn't think it's as good, it won't go up as much as the company you've hedged it against. So even if the market goes up and the share you want to short or be short of goes up, you can still make money even if obviously both of those companies go up, because that's called the spread, and that's called having a hedged position. So right, this brings me back to how this obviously brings liquidity into the market. So obviously you can see a lot of shares are traded hedged against other companies. So if you then lose that ability to hedge your position, you then do have to sell or your long positions also, because you can't, like I said, you can't just sit naked long if you're a long short fund, and you need to be hedged and you need to have lower risk. And even if you think, okay, well, we'll take an outright long position, the higher risk means that you can't take as big a position anyway, so you have to then sell a lot of the company anyway, a lot of the shares anyway, because you've just got a higher risk, you've got a higher volatility attached to your trade. So you obviously then have to then sell. So short sellers do provide a lot of liquidity, and then obviously any analysis that is done in the market isn't necessarily going to be correct. So some person might think a company is a sell and sell that and buy something against it, and another company might think that's a buy that and sell something else against it. So you can see they're going to be playing with each other in a way, so that they're basically providing liquidity in the market based on what their views are. So take that liquidity away, then you're going to have some basically a lot more volatility in the market because that liquidity is gone, and then that also has a domino knock-on effect of purely when you have more volatility in a market, you have to then reduce your position sizes anyway, and then some people will just want to step aside and get out of that market because of the volatility, and then that's more selling in the market. So you can see there from what I just explained to you that if they do ban short selling, and a reason why regulators may not be too hot on the idea is because they are fully aware of this, of what I'm saying. Long short only funds will have to liquidate, volatility will go up, then there'll have to be more basically exiting of capital from the markets, and then yeah, just it will just go a bit wild. So yeah, so I hope that helped you understand that concept, why I think that hopefully we won't have this, and then yeah, so yeah, there you go. Anyway, so remember, it's not financial advice. I'm not a financial advisor. Always do your own research, and I'll speak to you guys soon.